this video. I'm going to take you through the Blue Sky Toys case study, and in this video I'm only going to focus on the solution to it. We'll look at what we do with it, what we do with the solution, and how we can use the solution a little bit later on in the next video. Okay, so the case itself. Blue Sky Toys started trading in January in Cuddly Toys. Its first product is a cuddly owl, which it bought at a cost of £5.50 and sells for £8 through mail order and from a market stall. The supplier allows Blue Sky 1 month's credit on its purchases, and Blue Sky sells 30% of its owls for cash and the remainder by mail order, for which customers are given 2 months credit. Okay, and the bottom of that slide, that's how many purchases the company has decided to make for by its owls in it. Okay, it predicts it will sell the following number of owls in January 200 through to June 350, and to establish the business, Blue Sky has agreed a £500 bank loan from the bank, obviously. The first interest payment on this is not until the end of the calendar year, and the capital repayment is also deferred until the next year. So to enable it to trading, we've got a little bit of extra information about its costs. So we've got advertising at £500 per month, paid 1 month in arrears. Telephone bill of £75 per quarter, payable at the end of each quarter. Not sure why it says corner there, but each quarter. That's March and June. And then the hire of the market stall at £15 per month, payable at the end of the month. And then we've got miscellaneous expenses of £10 per month, payable in the month in which they occur. And we've got 3 questions. Actually, we've got 3 documents to produce. We've got the cash flow forecast for the first 6 months trading. We've got to produce a profit and loss statement for the first 6 months trading, and then produce a balance sheet as at the end of June. Now let's look at these 3 questions. Produce a cash flow forecast for the first 6 months. So we'll produce the cash flow on a monthly basis over those 6 months. The profit and loss statement is one profit and loss statement for all of the 6 months, not 6 1-monthly profit and loss statements. It's 1 column of numbers. And produce a balance sheet as at the end of June. And the balance sheet, we remind you, is the statement of worth of the company at the end of June. Okay, so that's the question, that's the case. Let's flip over now to a blank spreadsheet. And first step, as we did with the work cards case study, is transfer the information from the case study onto the spreadsheet. So a blank spreadsheet. Now, we're talking about January to June, so I'm going to first set up some months. January, and take that across to, I'm going to go across to August. The reason for that is they've become a little bit clearer, but you'll see why later. So, first piece of information we have from the case study is that the purchase price is £5.50, so 5.5, and I want that to be currency, so I'm just going to change that to currency, and that's the same for all the first 6 months. The selling price is £8, an 8 in there, and again convert that to currency and copy that across. Next piece of information is supplier credit, and that's 1 month. I'm just copying this across, don't need this really here, but copy it across for good measure. And buyer credit is 2 months. Then we have the number of purchases. So this is the purchase of raw materials, and we've got 300 in January, 300 in February, 350 in March, April, May and June. And we've got sales of 200 in January, 250 in February, 300 in March, 300 in April, 350 in June, in May and 350 in June. We have the initial bank loan of 500, and again that is in pounds, so we'll just keep it nice and clear all the way through. And we've got 30% of the products sold are sold for cash. So I'm going to actually put that up here. We've got cash sales of 30%. Again, you'll see why I've done that in a few minutes. You don't need to. You could put that in as a column, as a row if you wanted to. Okay, then we've got some trading costs. And the first one we've got advertising at £25 per month. Let's copy that across to all 6. We have the telephone bill, and this is £75 per quarter paid in March and 75 in June. Make those money as well. The next one we have is market stall hire. That is £15 per month, and we've got miscellaneous expenses. That's £10 per month. That's money as well, and they are every month, so we'll copy those across, usually on a slightly shorthand way. Okay, so that's all our information in. Now we can start to construct our financial documents. The first one is the cash flow forecast. Right, cash flow forecast. And first line, as you remember from the work cards case study, is cash in. Now we've got cash in from cash sales, and we've got cash in from credit sales. So cash in from cash sales is equal to the sales volume multiplied by the percentage sold for cash multiplied by the selling price. Okay, 480. Now I want to copy this cell across so I pick up every month, but if I do that, the cash sales percentage also changes. So I just want to lock that cell by putting a dollar around the B and in front of the B and the 1. Now when I copy that across, it always references that cell. So that is our cash in. Now, cash in from credit sales, we give our buyers 2 months credit. So January's credit sales, the cash comes in March. So that equals the sales volume multiplied by 1 minus the percentage sold for cash multiplied by the selling price, £8. But again, I want B1 to be boxed in place. That's 1,200. Now we've got 6 months worth of sales, 3, 4, 5, 6. So it means we get cash in from credit sales out as far as August, which is why I took it 2 months further on. Now we can do a total cash in equals the sum of those two cells. And I'll copy that all the way across to August. Cell, there we go. Copy that all the way across to August. Okay, so that's our total cash out. Now we've got, that's our total cash in. Now we've got cash out. And the first one we've got is purchases. Expand Purchases. There we go. Okay, so the purchases, because it's cash, we're talking about cash sales, cash in and cash out here. So we pay for purchases 1 month after we receive them. So we pay for January's purchases in February. So this cell equals the number of purchases in January multiplied by the purchase price. It's as simple as that. And we copied that across because we've got 6 months. We copied across to August because we have no figures for July and we're on 1 month's credit purchases. It shows up as 0 in August, which is fine. We can just leave that. Okay. Then we start to look at our other costs, and we can see from up here we've got advertising, telephone bill, market stall and miscellaneous. So I'm just going to copy those 4 down here as titles, and we'll just look for when these are spent. Now, advertising, it says, is paid 1 month in arrears. In arrears means it's paid 1 month after the cost is incurred. So we pay for January's advertising in February. Arrears is another one of those financial terms that you need to learn. We copy that one across. The telephone bill is paid quarterly. So I can just copy that. And the zeros are copied across. That's not a problem. And we might as well copy across to August. It only picks up the 2 and that's money. It only picks up the 275. The market store and the miscellaneous are both paid in the month that they're incurred. So we can just pick those up. And again, because there's nothing recorded here, we're not looking at transactions after June here, then we get zeros. So that's all of our cash out. So total cash out equals the sum of all of these up to purchases. Got that all the way across to August and convert it to money. So now we have all of our calculations, and we can start to make up the full cash flow forecast. So cash flow, well, we'll call it statement because we've already used that cash flow forecast term. Okay, so we start with an opening balance. Our opening balance is the bank balance, which is 500. Our cash in is the total cash in, which is up here. That's that cell there. Our cash out is our total cash out. That cell there. And we can have a net monthly cash flow. Net cash flow is equals the total cash in minus the cash out. And then we can use the closing balance of the opening balance plus the net cash flow. Then our opening balance for the next month equals the closing balance of the previous month. And as I did in the work cards case study, we'll copy these cells across all the way to August. And that is the figure that we're particularly interested in, because that's the closing balance at the end of the 6 months we're reporting on. So that's quite an important figure. So that's our cash flow sorted out. Let's now take a look at the profit and loss account. So profit and loss account. And we're looking for one column of numbers here, remember, not a column for every month. And the first line of the profit and loss account is sales revenue. So this is the total sales revenue for sales in the period we're interested in. So the easiest way of doing this is actually to look at the sales volume and multiply it by the selling price. That's easy in this case because the selling price hasn't changed. If the selling price changes, then we look at the sales volume in each month multiplied by the selling price in each month. So in this case, we can do it a fairly simple way. So it equals sum of the sales volume in the 6 months multiplied by the selling price, 14,000. The next line is cost of sales. And this is exactly the same. It's the number of units sold multiplied by the cost of sales, which in this case is only the purchase price, so I can put one of these £5.50s in. That gives us a gross profit of the sales revenue minus the cost of sales, 4,375. Our overheads are the sum of all of our overheads, and because I've laid these out as per information from the case, this is the amount that gets paid irrespective of when it gets paid, which is what we should be using here, matching principle. 450 gives us a net profit of 4,375 minus 450, or 3,925. Okay, that's the profit and loss sorted out. Balance sheet. Now, top set of figures in the balance sheet is usually the fixed assets, and in this case we don't have any. I'm going to put a 0 there. Then current assets. There are 4 types of current assets. First is cash in hand or in the bank. In this case it's just in the bank. And that equals that figure down here, the 1,080. Now our debtors, this is how much other people owe us, or owe the company. So we are owed for money on credit sales. And that equals the sum of these two cells here. These are the two cells that indicate how much we are owed, that's cash due in on credit sales that have not been received so far in our financial period. Let's close that off, that's 3,920. The other current asset we've got is stock. And the fourth one, just to remind you, is prepayments, which there are none. Stock. Okay. These are cash, these are monetary values. So stock. How much stock have we got? Okay, well we actually need to work this out. So let's set up a new block of the spreadsheet down here and call this stock level. We've got the opening stock, and we assume the opening stock is 0. We've got purchases, and we've got sales, and we've got a closing stock. Now, in January, we are purchasing 300. This figure up here. We are selling 200. So our closing balance equals the opening stock plus purchases minus sales. Our February opening stock obviously is January's closing stock, and then these are the same. And then let's copy these across. Just need to go to there. That is our closing stock figure, 250 units. So our stock that we have as an asset at the end of the period we're reporting on is 250. And the value of those is the purchase price, not the selling price. Purchase price is 1,395. Okay, next block of items in the balance sheet are current liabilities. This is money we owe, or the company owes other people that they have incurred the expense for in the reporting period but have not yet paid. And the two items for that is purchases, because they're on 1 month's credit, and advertising, because they're paid 1 month in arrears. So it's the sum of those two. Equals that plus that. Now we can, the only thing we've now got to do with the long-term liabilities. And the only long-term liability is the bank loan at 500. So now we have our net assets, which equals the fixed assets plus the sum of the current assets, those 4, minus the current liabilities, minus the long-term liabilities, 3,925. Now, a balance sheet balances, that's our net assets. In other words, that's how how the company is using the cash. Where does the cash come from? So where's the balancing figures? And this is net assets. In other words, the source of that money, and the only place it comes from is the profit and loss account. These two figures are the same, so the balance sheet balances. Got to be careful in that that only applies in the first trading period, and we'll see that in another video. But those are the 3 documents. So that's the cash flow over here, giving us £1,080. Our profit and loss gives us a net profit of 3,925 over here, and our balance sheet shows that we have a net worth at the end of the 6 months of 3,925. So just to remind you, the cash flow is on a monthly basis. The profit and loss is 1 column of figures for the whole of the 6 months, and the balance sheet 1 column of figures as at the end of June. And these 3 documents show how the numbers link together. Okay, so we have produced the solution, and what we do about it is the subject of the next video. So that's where we'll take our spreadsheet numbers and we'll play with them, because obviously there's a problem here. In February and March there's a negative cash position, which means the company is bankrupt. Not bad going bankrupt in 1 month. We need to look at that, and we'll look at that in the next video. Okay, thank you very much.